Calling all do-it-yourself ETF investors. Do you want to ring the bell at the Toronto Stock Exchange? Join us for ETF Investor Day, our first ever in-person event right here at the TSX on Thursday, February the 8th.
This investor education event will be focused on empowering Canadian ETF investors and providing informative content to help you navigate markets in 2024. There's going to be 3 exciting educational panels, which we've curated specifically for our ETF Market Insights audience. Our insightful guest speakers, who are ETF industry professionals, will provide you with the information and education you need to confidently manage your investment portfolio.
This will be an amazing opportunity to learn from ETF industry specialists and to network with like-minded investors while expanding your investment community. You won't want to miss this event.
Register today at etfmarketinsights.com.
We look forward to seeing you here with us in Toronto.
Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
This is ETF Market Insights. Welcome back and Happy New Year. This is our first episode of 2024. It's so great to have you with us in the new year. Today's episode, we have someone that hasn't been on the channel yet, and I'm so pleased to have him join us. Nicolas Bérubé, joining us from Montreal. Nicolas is a reporter for La Presse and an author of Zero to Millionaire. And we're going to talk about this book. I think there's a lot of audience members that will commiserate with a lot of things in the book shortly. But Nicolas, so great to have you join us on the channel today.
Thank you, Danielle. Happy to be here.
As always, we remind our investors today, we're not providing you any advice. We're not providing you any investment recommendations. Our show is all about education and empowering do-it-yourself investors to make the decisions that are right for you and your own objectives and goals. So Nicolas decided to write this book, Zero to Millionaire. He was a new investor thinking about putting his own dollars to work and doing it on his own. But Nicolas, you discovered quite early in your personal investing journey that investing can be hard, and there's some emotions involved as we invest our own money. So you start your story with kind of going over some common pitfalls that investors make when they're getting started. And I think a lot of our audience members will definitely relate to some things that you talk about in this book. So I want to know first, what made you decide to start investing on your own in the first place? And what were some of those initial mistakes that you made when you got started?
Well, what got me started, but basically I was about to turn 30 and I was just named US correspondent for La Presse. So I was going to move to LA and I would have a bit of a salary increase with that move. So I thought to myself, okay, now it's time to be an adult. It's time not to spend all that on restaurants and whatnot, a pair of shoes. So I decided, okay, I'm going to invest. And the year was 2010, basically. And the stock market had crashed the year before and the year before that. So it was a big time to start investing. And my big genius move at the time was that I was going to short the market, believe it or not, because the rebound, if you remember, in 2010 was very, very, very strong. And all around me in LA, all I could see was foreclosure signs, people losing their jobs. It was almost a depression. I mean, there was a man on my street sleeping in his car, and that was like you never saw that in a neighborhood where I was staying at the time. So it was really something. So I figured, well, this big rebound basically is a dead cat bounce, and we're going to go down in the next few years. So I shorted the market, and I think your listeners can know what happened next. But that was, that I lost about $10,000 during those first few months. And I always say that's the price of my education as an investor.
It's tuition. That's what we say. That is tuition in your personal investing journey for sure. And I think now we're seeing a lot of similarities where the market got really hot for a while. Investors were getting in, after the COVID pandemic and monetary stimulus. People were enjoying the market run. And now I think there's a lot of investors that are a little kind of fearful because markets aren't soaring as they were, and they're realizing markets don't always just go straight up. So we need to learn how to manage not only the return side of their portfolio, but the risk side as well. So Nicolas, since making those kind of initial mistakes, shorting the market, maybe getting overly confident with your bets, you've spent a lot of time analyzing what separates the winners from the losers within the investment community. So what did you identify as a common behavior for some of the most successful investors that you've incorporated within your own investment strategy?
Well, you just used the word, it's very interesting, the word behavior. And I think that's the answer right there, because when you don't know about the market a lot, you kind of have this feeling that, oh, well, if I just read a little bit more about this or that company, or if I just, I fine tune my selection process and all that. But the key word is behavior. If you don't have behavior, you have nothing, basically. You might buy the best company in the world, but you won't stick with it in the long run. So that was very surprising to me at the time. Like most people, I thought investing was all about finding the needle in the haystack. And I read, Benjamin Graham. I read Warren Buffett. I thought I was going to outperform and to have good results, but very quickly I realized that it's way better to go broad and to buy the whole market instead of just trying to pick stocks. So that's surprising. It was very surprising to me. And also the fact that 95% of professional investors do not outperform the index over the long run, as we know with the SPIVA studies published twice a year. So that was very, very surprising to me. Also, I think that just being a DIY investor doesn't make you a great investor to begin with, because you have also to deal with your emotions, your challenges, and we know that DIY investors often underperform. So it's not black and white, but there's definitely a way to to make your investments grow over time and to allow them to compound. So behavior to me was the very, very the concept that I found most interesting, and still to this day it never ceases to fascinate. The fact that you can be very knowledgeable, you can be a person who's had a lot of success in their life, you can be a doctor, you can be a very highly regarded person, but as soon as you open your brokerage account, you can be like a beginner, you can be your own worst enemy. So to me, that's why investing is so interesting.
Yeah, I think a lot of investors, do-it-yourself investors, can get overly confident, especially when markets are running, right? And I'm guilty of it as well. We let our emotions kind of dictate sometimes what stocks or what funds or investments we're picking, and therefore that might not always be the most suitable for our own objectives and risk tolerance and goals. I love that you highlighted the SPIVA report. So for those in our audience who haven't heard of these yet, you can Google this, SPIVA. The SPIVA reports are the facts that really show that index investing, especially over the long run, has had some quite powerful performance, and that picking stocks is really, really hard, even for the professionals. And index investing is a great way for investors to look to enter the market, kind of take the guesswork out of it, and keep performance pretty steady with the market. So thanks for highlighting that. So Nicolas, based on your research, What have you discovered has been kind of a more proven way of investing, or a more accessible way that DIY investors can invest rather than, shorting or stock picking?
Well, as Jack Bogle used to say, you should buy the haystack instead of trying to find the needle. And why is that so important? Well, it's because our analysis and our best intentions are often go wrong. For example, if we could go back with a time machine to 2020, just before the pandemic, what stocks would you buy? You ask that to the random person, maybe they will say, oh, I would buy, I don't know, Pfizer, right? Pfizer made the vaccine, we all got the vaccine, so that makes a lot of sense. Well, if you look at the performance of Pfizer, let's say since the pandemic, it's way down if you compare it to Starbucks, which has a lot of problem during the pandemic. They closed down for months or even years. So it's so counterintuitive. So, if you buy the whole market, you'll have, market returns. That sounds, very easy, but and we know from international studies that have looked at this for generations, is that the returns of stock markets around the world, if you compare them to treasuries, the outperformance of the stock market comes from 4% of all listed stocks around the world. So if you don't have those 4% in your portfolio, you're not making any money. Okay, to me, that was the big aha moment where I realized, wow. And then the trick is those 4%, it doesn't stay the same. Obviously, a few generations ago, it was GE and Kodak and Sears. Those were obvious, right? And it's not the case anymore. So moving forward, it's very easy to identify in 2024 who are the big companies. But in 5 years, in 10 years, 20 years, 25 years ago, there was a company that nobody would have bought, right? They made computers that very few people bought. Our graphic design type of people, the company was Apple. Okay, so if you skipped Apple 25 years ago, you're not a happy camper today. So if you buy the index, you don't have to be trying to divine the future. You don't have to be clever and can see around corners. You just have to buy the whole market and hold on to it.
Yeah, it's such a good point. And so I think this is where we can start talking about ETFs in our conversation, because, we love talking about ETFs on this channel. But ETFs seem to solve a lot of problems for do-it-yourself investors because they really fill the gaps for all those pitfalls. It's a diversified investment rather than having to pick a stock. You get index investing is made really accessible using ETFs. So I know, Nicolas, that ETFs are a type of investment that you speak pretty highly about, and that you are an ETF investor yourself. So talk to me a little bit about the benefits that you see using ETFs and why they're so appealing, especially for do-it-yourself investors.
Well, they're so accessible, right? And what strikes me also is that the price of admission, the investment fees are so low. And when you look at the returns, you always have to subtract the investment fees that you pay every year. And very few people understand that just 1% or 2%, okay, that might seems very small if you compare to the tax we pay when we go buy a bag of chips or anything like that. But the 2% of all our money that disappears every year, it makes very difficult to have good investment results over a long period of time. Because if you pay 2% in fees and inflation is 2%, let's say, now you're at 4%. And if you're a conservative investor and you don't want your portfolio to move around a lot, your returns might be a little bit on the conservative and low side. So if your returns are 5% and you pay 4% in inflation and fees, you're just making 1% on your money. So very few people realize the cost of high investment fees. With ETFs, the costs go down to sometimes 0.2% or even lower than that. So that's a big plus for investors. And also, what I would say is, I think ETFs are getting more traction in Canada, of course, but very few people are skeptical because they say, why would I have average returns, right? You have the market return, so you have the average. And average doesn't sound very appealing. The thing is with average is if you can keep doing average for 5 years, 10 years, 15 years, 20 years, you're not average anymore. You're in the top 5% of all investors in the world. Okay, so average is a bit of a misnomer here, because who likes to brag on a golf course that they own, the Canadian market, or that they own the S&P 500? It's not very exciting. But if you look at the returns and if you look at the behavior over a long period of time, you're not behind the pack. You're in front of the pack. So that's a big thing to keep in mind.
I love it. Average year after year actually compounds, so therefore you will be above average in the long run. And again, highlighting those SPIVA reports. If you're someone out there that doesn't believe it, the proof is in the numbers. Read those reports. Longer you stay invested in an index fund, the harder it is, the easier it is to outperform active managers. So ETFs make a lot of sense for do-it-yourself investors. We talk a lot about that on this channel, and Nicolas highlighting it really well again. But more specifically now, we have these types of ETFs called asset allocation ETFs. And these even take investing a step further for DIY investors, simplifying it even more as they build out portfolios and really helping remedy some of those early mistakes you talked about, Nicolas. So talk to me a little bit about asset allocation ETFs and why you find these so appealing.
Yeah, they're what I like about them is their simplicity. I mean, you open your account, you have one line. Okay, one line, because all your Canadian stocks, US stocks, international stocks, emerging market stocks, and your bonds are all wrapped into one asset allocation ETF. So that makes it very easy to manage. Let's say on an account like a TFSA, people might in January want to contribute their $7,000 this year. So you just open your account, you buy for $7,000 of this asset allocation ETF, and then you close, you forget about it for a year. So it makes it very easy. And I think a lot of people are a bit scared, frankly, about, okay, I want to invest in ETFs, but there's thousands of them. What do I do? I mean, I get this question in my mailbox almost every day. People, they want to do the quote unquote right thing, but it's scary out there. So these asset allocation ETFs, they remove a lot of the guesswork. All the funds are already neatly wrapped for the investor. And also the rebalancing is done for them, right? When you want to add new money, it's very, very hard to buy the laggard, right? Because we all want to buy the S&P 500 because it's been so popular it's been doing so well for a number of years. But people forget that if you go back in time, let's say the first decade of the 21st century, from 2000 2010, the S&P 500 was not popular at all. I mean, all it did was crash and not making any money. So if you're able to, engineer this kind of bad behavior out of your routine, and just buy the asset allocation ETF, you don't have to think about that. You don't have to be a genius, and you don't have to fight your instincts. You just buy this one fund and you forget about it. So to me, and also if me, I'm interested in managing my own investments. Many listeners are probably, but let's say I get hit by the proverbial bus and my wife has to deal with my investments, and she opens this and she sees like 20 line of funds and ETFs and all this and that. I mean, well, what will she do, right? So if she opens the account, she sees one line. It's very easy. So a person who's not her husband and wife who's not interested in all this can easily manage their portfolio, without a lot of knowledge or reading or all that. So I think They really help a lot.
They really simplify investing. And you're right, you do not have to be a sophisticated investor and monitoring the market daily to use an asset allocation ETF. Really, all you need to determine is your risk tolerance, because with asset allocation ETFs, you can choose how much equity and how much fixed income you want in your asset mix within your balance. Obviously, more fixed income is less risk. More equity is bringing more risk onto the table and more opportunity for long-term growth. You determine what's right for you, and you just need to pick one ETF that fits in with that profile, and you're exposed to the entire global equity and bond market for less than 20 basis points, so less than 0.2%, because I know, Nicolas, you talked about fees as well. It's very powerful. Have a low fee investment. You don't have to rebalance, don't have to buy anything else. You set it and forget it. I love that. Nicolas, it was so great to connect with you. I want our audience to know how to find your book if they're interested in reading more about your investment journey.
Yes, so the book is called From Zero to Millionaire, and it's available in bookstores and on Amazon and on Kindle format as well.
And in English and French and other languages to come, we were discussing before. But English, it was published first in French and now available in English. So check it out, especially if you were late on some holiday shopping and need to get a quick gift for a friend or family member that's interested in starting investing. Really great what Nicolas outlined in the book. It was so great to have you on the show, Nicolas.
Thank you for having me, Danielle.
Thanks to everyone for joining us, and we'll see you next Friday.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.